afternoon session after lunch and a fantastic presentation from Ambassador Napa. It's a tough act to follow, but a couple things. You heard it first today. Mike Kokolari, he called it Vietnam Olympic Games. Okay. Does anyone here in the room know, perhaps my Vietnamese colleagues don't put up your hands, but when did Vietnam win its first ever gold medal at an Olympic Games? Quite recently, 2016, Rio summer. What sport? Shooting. So there you go. With the panelists I have today, my objective is actually to form the first ever Vietnam bobsledding team for 2030, probably in time for the opening of the US Embassy. But in all seriousness, we are here this afternoon for other form of sports to talk about the VOF fund, the VinaCapital Vietnam Opportunity Fund, which for some of you who have been following us, and my colleagues here on the panel will introduce in a moment, we have been running this fund for as long as this firm has been around, for 20 years. So in 2003, this fund was launched. I think the stock market was 3 years into its infancy, barely learning to walk, 50 listed companies, very, very early days. And I think the first investment we did was a private equity investment. And I think a lot of that still DNA still carries through to what we do today. And today, we're here joined on the panel today, and I'll hand the microphone over to Todd Davis and Priyesh Palmer, both from Numis Securities, both based out of London, our advisors and brokers, have been working with this fund for over 10 years now, so over half of our existence, and very familiar with what we do, as well as Andy Ho, Chief Investment Officer, Lead Portfolio Manager for the VOF Fund. My name is Khanh Vu, and I basically go around the world carrying bags for Todd, aside from helping Andy run this fund for the past 10 years. Today we're going to spend the next half an hour really to cover off a couple of things. We've heard this morning about Mike and Paul talking about the Vietnam economy, where it's heading towards the opportunities. We've heard from Tu and from Ling about the stock market, how our investment process, or the public equities investment process, how we look at it. What we'd like to highlight is, the comment we made earlier, just the DNA of this team, that private equity approach. We want to share with you, perhaps, for those who may not be familiar with VOF, a bit of history about the investment company industry or market, which is where VOF is listed. We'll follow that up with, what is VOF, right? Why is VOF perhaps one of the best access vehicles for accessing Vietnam opportunities? We'll talk a bit about the performance and delve into some of the activities that we've had in place. And we'll round off with about 5-10 minutes of Q&A at the end. So with that, Todd, I'm going to pass it, Priyesh, I'm going to pass it to you. Priyesh, you used to be in research at Numis, so you've covered this fund for a long time. Tell us a bit about the market.
Sure. So first of all, thanks very much, Khanh. You stole a bit of my thunder there with the intro to Numis. For those of you that don't know us, we're a firm of roughly 300 or so people, London-based stockbroker. And Todd and myself, excuse me, work in a specialist team that focuses on London-listed funds. So if you just move to the next slide, our universe comprises around 400 or so funds, roughly 250 billion pounds sterling of market cap, and that's roughly split between equities, 50%, and what we call alternatives, 50%. And the growth in this universe has very much come from the alternatives space, as the closed-end fund structure is naturally suited to holding illiquid asset classes and illiquid investments, which is very relevant to VOF and what VOF does, and we'll touch on that in a minute. Now, within our universe, this Asia-Pacific or emerging markets component is roughly 7% of the market cap. And if you look on the right-hand side chart there, you'll see that Vietnam is roughly 12% of that. And what's interesting here is that it's really punching above its weight. And so if you look at, for example, countries such as China or India, which are significant components of the emerging markets index, they're only 9 or 10% of the closed-end fund universe. So sort of drilling into this, why is Vietnam overrepresented? Well, as Khanh briefly mentioned, as an access play, the closed-end fund structure works perfectly. And when this fund was launched, I think it was roughly 10 million, or so market cap. There weren't any other ways to play Vietnam. This was one of the only ways to do it, and to be honest, that remains very much relevant today as well. So why the closed-end fund structure? As I mentioned, being able to hold illiquid assets, Vietnam is overrepresented. Just moving on to the next slide, who owns VOF and what does the shareholder register look like? So originally, when the fund was first launched, it was very much sort of private banks and individuals, but that has developed over time to more sticky type money from institutions and private wealth managers. And I think that the next kind of growth leg in the shareholder register for VOF, and this is relevant across all closed-end funds, is retail and attracting that retail investor. So with that, I'll probably hand over to Todd.
Thanks, Priyesh. Yeah, in a previous life at an American investment bank, I bought into VOF very soon after the launch and was quite quickly asked by the risk police why I'd bought Vietnam. I think a combination of your hard work and your peers' hard work over the first 10 years, I think now it's pretty well established why you want to own Vietnam. But to me, maybe the question, following Priyesh's point about access to the market's grown significantly. What is VOF? What differentiates it from its peers? And why should they buy it? Andy.
Thanks, Todd. Yeah, I think, like Khanh said, I think VOF provides one of the best access to Vietnam opportunities out there. And what's unique is that our approach to investing is we look for businesses that benefit from the growth of the domestic economy. We look for these businesses while they're in the private state. Some of it is family-owned, some of it's SOEs, but we look to invest in these businesses when they're smaller. They're about $300, $400, $500 million. And we provide them growth capital. We take a minority stake. But what's key about some of these businesses is that they have a great management team. So we look for businesses that benefit from the growth of the domestic economy. They have a great management team, and we apply a private equity approach to these investments, which means that we want to do due diligence. We really open the hood of the car. We check the engine. We check the wheels. We check everything, from financials to legal to ESG. Then we sit down with the management team and say, okay, where are the improvements to be made, particularly in the ESG space, for example. We'll apply condition precedent, something you need to do before we fund you, or condition subsequent, something that you commit to do after we invest. Over time, we will participate at the board level or at the managerial level, help the business grow. We don't go in and replace the management team. We are looking for good management team to back, but we help them enhance. In other words, we'll bring in a CFO or a product development person, a few international experienced hands to help them improve on the management side. Over time, we like to take them onto the public market. We continue to hold on to them as public holdings, or we take them to a trade sale. The last one we did was a few months back. We sold the largest PET bottling business to Indorama out of Singapore/India. And that's an example of entering into a business that's in the consumer space, not directly, but indirectly, because they do PET bottles, helping them restructure the business, helping the management team enhance themselves, buy new equipment, and then put it into the hands of a strategic for a nice return.
So Andy, the market now is probably 800 listed companies.
Close to that, yeah.
Why do you still need to enter via the private route? And in your crossover investments where you're investing in public companies at private terms, why do you still need to take that approach?
Yeah, we have 3 stock exchanges in Vietnam. We have a total of about 1,600, 1,700 companies. In the Ho Chi Minh City Stock Exchange, where primarily all the key companies are listed, It's about 700 companies. We do participate in the listed space. Our exposure is roughly 60, 70% exposed to the listed space. And by and large, those holdings were invested when they were private. But we continue to spend the bulk of our time looking at the private opportunities. I think at the end of the day, we need to demonstrate to our shareholders that in the long run, we have to deliver an alpha, we have to deliver a return that's commensurate with the risk that we take on the private side. And I think over the years, we have demonstrated that private equities do deliver a higher return than listed. So just to give you some examples, can you put up some slides? We deployed over the years roughly $770 million, and we've realized about over $1.5 billion back on private equity, roughly 50 private equity deals, and it delivers about 21 to 23% IRR. If you look at the public equity market, which we obviously like as well, the return, if you look at different periods, 3, 5, or 10 years, it's anywhere between 5 to 12% annual return. So clearly, the private equity deals that we've entered and exited and give it back to VOF have delivered an average return of 21, 22, 23%, basically outperforming the listed market in the long run. And I think that's what shareholders care about, is the return. Now, I can go into the details of why it's interesting. It creates jobs. It gives the ability to manage ESG better, all that stuff. But at the end of the day, I like to say, look, it delivers a return that is significantly higher than what you can get in the public equity market.
Can you give us some examples that demonstrate that in your portfolio?
In terms of return. So I can give you two types of example. One is a company like Hoa Phat, HPG. We invest in this business. It is now the largest steel company in Vietnam. We invest in this business when it was about number 11, number 12 largest in Vietnam. They were importing scrap metals, and they were buzzing the scrap metal down to make construction steel. We invested as a private equity, put $50 million in. It was roughly $450 million in value. This is in 2008, 2009. Over the years, we've helped grow this business. I sat on the board for 6 years. The business grew over the years. In 2021, they deliver $1.5 billion of profit after tax, one of the highest in Vietnam. Now, obviously, steel goes in cycles, and they've done so well in the years after that, but they still value themselves at about $6-7 billion today. Now, this is an example where we enter as a private. We continue to hold on to them because we believe its growth continues, and today, it sits in our portfolio, but in the public equity space. Another example on the private side is a hospital. We currently invest in 2 hospital platforms. We invested in 3 before. We've exited one, which is called Hoàng Mỹ. We are now investing in 2. There's one in the southern side. We consolidate the space. We invested when this hospital platform has 4 hospitals. Today, they have 8 hospitals, and the 8th hospital is a challenge. It's not easy. The 8th hospital was taken out of bankruptcy. It was an operating asset. It sat in bankruptcy for many, many years under Sacombank, which is one of the leading commercial banks. Someone finally took it out of bankruptcy, cleaned up the record, cleaned up the ownership record, and then sold it to Tâm Chi, which is the hospital platform we own. And now we have to not only put money into acquiring the operation, but also refurbish it. So roughly a $60 million endeavor for Tâm Chi. And this is where the business in itself has generated sufficient cash to make that acquisition in addition to having commercial loans. Right? This is how we continue to build on the private side, because if you want access to healthcare, you can't have this, because on the public equity, there's only one company, one healthcare company in the province that delivers healthcare, where we can have access to healthcare in the private side through these various platforms.
Yeah, I mean, if I could add, on that healthcare platform, with regards to healthcare platform, we are, I think, today the largest private equity investor in hospitals and clinics in the country. And this sector is becoming incredibly interesting, right? You're seeing a lot of regional funds raise healthcare-specific platforms. So for us, the ability for us to identify 2 very strong, very good management teams that can build our hospitals. And now what we're doing is we're bolting on, these, rather than going out and looking for one asset, we're able now to keep and build off a very strong structure that we've been able to work with management. And this is sort of the idea of bolting on new investments to expand it. But I just wanted to just to highlight on this previous slide here. As Andy mentioned, today 70% of the portfolio is public equities, and we get asked the question, hang on, but you get on here and you talk to us and you talk about private equity or privately negotiated, but yet your portfolio is public equities, 70%. And the point being is that we look for businesses where we can come in early, where we're able to take positions in these businesses, perhaps pre-IPO, private companies, work with them, grow with them, and then help them cross over to become publicly listed companies. And in some instances, we hold on to them because they are still growing very well. They are they're normally top performers, top market shares in their segments. And how do we demonstrate that? Well, if we look at the portfolio today, and you sort of shift the lens, right? And you say, well, hang on, how did you guys enter into those positions that are in your portfolio today? And what you discover is 80% of the portfolio was entered through a privately negotiated means, meaning that we're not going onto the market, and buying stock, right? And in fact, if you look at our portfolio turnover, it's very low. On average, it's historically about 12% on average. I was talking to one of my board members yesterday, who's ex-Aberdeen. I think he said back in those days his portfolio turnover was only 5%. So that's certainly a target that we're going to have to look towards. But a low portfolio turnover implies that we have high conviction in high quality companies. We spend a lot of time through that due diligence work to identify good management, good companies, and then we work with them to grow. In many instances, we are looking at a holding period between 4 to 7 years. Right? If you looked at the private equity investments that Andy mentioned, where we're delivering on average IRR 21 to 23% on realized investments, we're holding on and working with management for a few years through many cycles. So it allows us to really accrete the value through that process.
It does, Khanh. I think it was Mr. Lowe from Keppel earlier who said that when they're investing here, the public market doesn't give them access to the whole of GDP. It doesn't give them Vietnam's DNA necessarily. Andy, when you're looking at an investment, and does the investment idea come first or does the company come first?
Yeah, that speaks to our portfolio construction, right? What we do is we review every 6 months the expected return of each of the sectors. So we look at all the sectors that's relevant to what we do in Vietnam. Then we look at the associated risks for each of these sectors, roughly 3 years out. We may get it wrong, but at least we sort of project what sort of earnings we see in each of these sectors, whether it's manufacturing, logistics, infrastructure, healthcare. And then we apply a set of risks associated with that. So we get what we call an expected risk-adjusted return. So from there, you can imagine that we would put a lot more weight on sectors that deliver a higher level of risk-adjusted return. And then from there, we then identify the companies within those sectors. We don't need to identify the top companies. We just need to identify companies with good management team that has potential. And the potential, where we see potential is where the improvements can be made, whether it is in, the steel company. We could have invested in the number 1 company, which would have been out of business today. But we chose to invest in the number 10 to 11 business, who has an idea that's completely different, which meant they had the idea of building a fully steel complex, fully integrated steel complex, which meant that they had to source coke and iron ore in Vietnam. And why was that important? Because at that time, the government of Vietnam was actually applying an export tariff on the commodity. They wanted businesses to keep the commodity in the country and process it. And so by purchasing the commodity in the country, they were able to get it at a discount relative to the international price of the commodity and able to produce steel at about half the price of their competitor. Right? So the uniqueness of these businesses drive us to look for the investment. So effectively, we say we look at the sectors, then we look at the good companies, the great management team within those sectors. We talk to them. We understand all of them, but we talk to the ones that have the most potential for valuation that increase over time. But the other thing is, keep in mind, we don't make money until we exit. So we always go in with a mindset, well, are these folks motivated to list the company or sell it to strategic? Because if they're not, we may find ourselves in a bind.
And talking of performance, how's that been reflected in VOF's performance over the years?
Yeah, and I think we are long-term investors, and so we are investing for the long term. So when we look at performance, we do look at over the long term. Certainly, these three charts, we're showing that over the 1, 3, and 5 years, and it's important because we've been through several periods of volatility. If you look over the 5-year, we've been hit with both COVID as well as the challenges to the real estate sector that we've heard a little bit this morning from some of the panelists on the real estate. And over the shorter term, obviously those challenges in the real estate sector have been amplified. But that being said, quality of holdings, high conviction, working with companies, being active in working with companies has allowed us to deliver long-term performance. And this is a chart that what we actually prefer looking at. Just follow with me for a moment. On the bottom axis is risk. So you have low risk all the way out to high risk. And what you really want to be is delivering low risk. And what do we mean by low risk? It's essential, for you as investors, it means how volatile is the return that I'm giving you? What's that? The standard deviation. So if you're having a lower standard, having a lower volatility is, I guess, what you really want to seek if you're looking to invest into a market like Vietnam. On the vertical axis is your return. So again, you want to be delivering a high return. What we're targeting is lowest quartile volatility, highest quartile returns. And I think you can look at our peer group, and some of them certainly deliver similar levels of return. But over that period of time, and this is a 5-year view, there's a lot more volatility. Speaking to the underlying portfolios, the portfolio selection and construction. So what we say is, perhaps another analogy, is that if you come to Vietnam, you're looking for a roller coaster ride, there are some funds here that will give you that. But what we're going to offer you is like a plane ride. Smooth takeoff, smooth landing. And when there's turbulence, you've got an investment team here that has 20 years of experience that will, hopefully know what to do during times of turbulence. And that told us, perhaps, we're not going to perhaps go into the numbers, but the objective, and that's what drives how we look at performance and then how it builds into the investments that we're looking at.
Yeah, and it helps build investor confidence and understand. Perhaps you could go into some more recent activity to demonstrate how you've played the market and the volatility we've seen over the last 18 months or so through some of your investments.
So recently, the market volatility has allowed us to enter a new investment called VP Bank. We took a large position of VP Bank about less than a month ago. And the catalyst for VP Bank is, one, valuations come down to about 1.1 times price to book value for the bank. But they also have a commitment from SMBC to do a $1.5 billion investment in that business for 15% stake, and they're going through the approval process. We're confident that that will happen. And but the bank itself is a high-quality bank, a great brand. We've had a lot of success investing in banks like ACB, which is our largest holding, and OCB, and we felt that VP Bank, pretty much a big player in the northern part of Vietnam, would be a great addition to the banking portfolio. So it's listed. We took a large position, and we have some downside protection on the investment as well. Another recent investment is into a company called Chisalon. It's the largest media infrastructure play in Vietnam. They do all the television, LCD, LED screen that you see near the elevator shaft, the doors, in residential buildings, in office buildings. They have about a 75-80% market share. It's incredibly important to have a large market share because if you're a Unilever or Prudential, when you want to advertise, you want the most footprint throughout the city and throughout the country. They deliver that. And by delivering that, they're able to command a much higher premium to getting the content across to the viewers of the advertisement. Now, clearly, when we looked at this deal, everyone's looking at, okay, the competition for eyeballs, for attention, is the phone, right? People go to the elevator, they may not look up, they may look at the phone, right? The competition for this space is television advertisement. It's also magazine, it's also newspaper. So we see a lot of competition for the attention span of the individuals, but we do feel that in the long run, this is a space where there's a lot of, it's becoming a normal part of life to see advertisement in the elevators. And the next step for these guys is to move into the public transportation system, right, to get the attention of folks and to be able to advertise. This has been a proven model for China. Companies called Focus Media, a couple billion-dollar business. In Thailand, they're big. In Singapore, they're big. So it's something that I think a lot of people in Asia pay attention to. And so that's an example of a private business that we invested in. I think we deployed, $40 million into this business, in a private business, and we hope to grow this business over the next 3 to 5 years.
So I just want to add on VP Bank, and Kentaro-san, I don't want to point you out, but we do have SMBC country manager here. So if you have questions on VP Bank, direct it to Kentaro later. But it's a obviously SMBC. You've been a long-term investor into VP Bank, and it's certainly a testament to quality. You heard this morning from Chairman Hui from ACB as well. One of the probably best retail commercial banks in the country. Those investments that we make, they're not buying on the market, right? I mean, this was a big allocation we made a month ago. ACB, we picked up about 2 years ago, about a $70 million position. These are large investments. We're not, our strategy is not simply to buy on the market there.
So banking's your biggest sector and the biggest part of the market, and you've entered it privately and publicly. But how have you fared in the last year or so in the real estate market that perhaps been a bit more bumpy? Khanh.
Yeah, thanks, Todd. I thought we've covered that this morning with Nam Long and the folks at Keppel. But look, certainly real estate is the largest allocation in the portfolio, second to, followed closely by financials. Real estate makes about 24% of our VOF portfolio, and financials make about 20%. If you look at the Vietnam index, financials actually overrepresent themselves on the index. They make up approximately about 40%, 41%, banks and non-banks. And real estate, it makes the second largest sector allocation on the index at about 17%. If you were a MSCI EM investor, and I was looking this up this morning, the largest sector allocation is IT, right? 21%, mostly dominated by Taiwanese and Korean firms. Financials are coming in close second. So here in Vietnam, the dynamic, and as you heard from conversations this morning from our panelists, real estate is a very important sector in the country. And if you listen to what the folks at Keppel or Nam Long have said, you've got to plant the seed. So we have been planting the seeds over the years, but occasionally you get a bad season. And last year we did have one of those seasons. And for those wine buffs out there, who knows, right? It might make for a great vintage in good time. But you can see here in this chart, it's looking at the 12-month relative performance of the Vietnam index versus the real estate index. So it's a composition of the real estate companies on the index. So we started off 12 months ago all the way to 30 June this year. And it's really a period there's two periods that you have to look at. The first 6 months, you can see that the index was down 16%, but the real estate sector was down 38%. Most of that really took effect in the last quarter when the policy measures perhaps to tighten liquidity, to address perhaps a bubbling or an excessive asset bubble that was, to address the corporate bond issuances that were being sold, missold potentially. The tightening measures really caused a sharp correction in the index, but importantly in the real estate sector. Then if you look at the first 6 months of this year, the index is up 11%, the first 6 months this year. In fact, it's up about 11% year to date. The real estate sector, interestingly, was up 8%. So after a 38% drop, we're still got a bit of way to go to recover. So what does that mean for our portfolio? Well, we invest, as I said, our largest sector allocation, 24%, is in real estate. Many of those real estate investments are in what we call public equity private terms. These are public companies that we, as Andy had mentioned, have negotiated private terms, terms that buyers on the market will not be able to have access to. We're able to seek the downside protections, perhaps performance minimum IRRs. We have what we call belts and braces. So we have security and collateral that comes with these investments, perhaps in the form of listed shares. That's why we've called it like that. Well, over that 12 months, and in particular the first 6 months, if you look at this chart, when the market corrected, we also took a very prudent view and had 2 down rounds of valuation adjustments to recognize that, yes, there is volatility in the market. We have external valuers. KPMG do our external valuations. PwC are independent auditors. They've looked at this, and they've, these down round adjustments that happened in November last year and December reflect that volatility.
So interesting point there about your privately negotiated deals. How do you go about benchmarking those positions? Do you do it versus an index, or is it a deal-by-deal basis? How do you think about return profiles?
So in terms of valuing those positions, I'm not sure if we're benchmarking, and certainly the fund doesn't benchmark, but in terms of valuing those positions, very similar to our private equity investments, they're independently valued twice a year. However, if there is a impairment or a event where it's deemed to be prudent that we should adjust, those valuations have been taken, have been recognized. Now, we're in a closed period at the moment. The accounts are being closed off at the moment. We're not disclosing anything at the moment. But I believe by the end of October, when we do release the accounts, we will be updating those values. But I think what's important here is that we need to recognize that, and I think the Nam Long presentation discussed this, that there is certain things that have happened over the past 12 months and that will be happening by the end of the year that will see an improvement to the real estate sector. One, we are seeing that corporate bonds that were issued last year and that could not be rolled for whatever reason due to the liquidity crunch, we're beginning to see 2 things happen. One, that bonds are being, new issuances or rolling over bonds, early indications are showing that that's beginning to happen. Importantly, the government introduced a decree earlier this year that allowed bond issuers to kick the can down the road, to push out the repayment terms up to 2 years out, and that certainly helped alleviate some of the pressure that's been on real estate developers. The other thing is that Vietnam was one of the first economies in the world to pivot. We've actually had about a 250 basis points decline in policy rates. That's actually passed directly now into lending rates. And you're seeing now that lending rates now are coming down to levels that are more palatable, more acceptable, that is allowing business owners to think about capital expenditure, to borrow, to grow. So declining rates have all certainly helped. It also has meant that money that was left in deposits earning 10, 12% now wants to find its way into the market. So the stock market, we've seen liquidity improve, and 2, back into real estate. We're also seeing wholesale sale of projects. And this is important because in the past, developers would sort of build and sell units. It's been a difficult 6 months, 12 months. And we're seeing what instead has happened is developers being able to sell whole projects. And that's allowed them to also to access additional liquidity to, 1, address maturing bonds, to invest into potentially new land banks. Infrastructure, we heard in the previous conversation, and in our next presentation, we'll be talking about logistics, which is a really core part of infrastructure. Infrastructure is being built out. You know, if you were to drive today to just out to the coast, to the beach resorts out in Muinair, a year ago, it would take you 4 hours, and if it was traffic jam, it would take you 8 hours. A third of your day would be sitting in the car getting to a beach resort. Today, it will take you 2.5 hours with traffic, and you can drive up to 100 kilometers an hour, probably more if you're daring to. But that's the kind of infrastructure that's being put into place. You know, in addition to the ports, and all the other infrastructures that are going to be important. And I think finally, the government again is looking to help through other policy measures. They've increased credit quotas for banks to lend to developers and for mortgages. They've also allowed homeowners, for the first time ever, to actually refinance with another bank. It sounds like a foreign concept for many of you who actually are property owners in developed markets, but that wasn't a concept until now, until July. That if you had a loan with VP Bank, for example, you could actually go to ACB, for example, and refinance and borrow. So all of that is creating, I guess, liquidity, a bit more confidence in the market, and I think that's trickling over to how we're looking at our portfolio.
So, Briash, just real quick. Just want to make clear, we don't benchmark VOF performance against the index or any sort of benchmark. If you go to slide 20, so when we make the investment, we do target a minimum return of anywhere between 15 to 20% per annum over the next 3 years. And that's a function of the risk we take on. But clearly, people do ask, okay, well, how do you perform in the long run against the VN index? Well, the only component that can be compared to the VN index is the capital market component, which we have been very fortunate to inherit great companies on the private side onto the listed side. So if you look at the performance on page 20, right? If you look at the performance on page 20, the 3-year performance, just the return, the cumulative return on the capital market component for 3 years was 72%. These are companies we enter when they were private, and they migrated onto the public equity side. If you compare that against the index, they deliver 40% return, right? And so that's the only component. We don't want to, we tell our investors it's not important to compare the index. It's important that we deliver long-term return that's commensurate with the risk that you take on in Vietnam.
Do you have a preference for your companies, your private companies, then to list, or do you prefer trade sale? Like, what's your view on exits?
I do prefer trade sales. It's so much cleaner, but you have to have experience. I've seen so many private equity people fumble. The reason lies in what we call reps and warranties. They didn't set up their company, they didn't manage it properly over the 1, 2, 3, 4 years they invested, and when the trade buyers or the strategic buyers come in, they give you a list of reps and warranty. Are you gonna agree to them? You have to. Otherwise, you can't get the valuation. We are seeing one deal right now, a live deal in the market, where the reps and warranty has eroded the gross return of the investment. Right? So if you do private equity investment, you know that if you're gonna go to a trade sale, you're gonna have to commit to a number of reps and warranty, and so you need to clean up your situation and be prepared for that.
Andy, I think we're heading to the Gem Centre later for dinner. Bringing a few of these things together, you recently took Nova food and beverage business as collateral for one of your private terms trades. How do you see that deal working?
Yeah, so probably need to step back a bit and see what happened. We made an investment in a company called NCG, which is owned by the Nova Land Group. NCG is a food and beverage company in the agricultural space. The business didn't perform in accordance with our downside protection, or what we call a performance commitment in terms of revenue and profit. It didn't perform as committed. So rather than continue to hold on to the shares in the business, we decided to put the shares back to Nova Group. But as you know, they are part of the real estate sector, and they have some challenges in liquidity. So in lieu of taking capital or proceeds for the put option, we swapped it with their 100% ownership of their hospitality business or restaurant business. So we took on the restaurant business. which has about 16, 17 brands, including Jumbo Seafood, Crystal Jade, Fin Deli, etc. And then we took that, we said, well, we don't know how to manage this. So the second day, we insert this into what we call In Holding, which is the owner of GEM. We are an investor in Holding. So we inserted this asset into that business in return for a debt instrument from In Holding to VOF. So basically, we put the shares back to Nova, but in lieu of getting cash, they gave us 100% ownership of their restaurant business. But instead of taking on a direct ownership at VOF, we decided to sell it to In Holding in exchange for a debt instrument. They have more experience managing restaurants than me. I don't know anything about restaurants. And hopefully, they'll continue to build the brand. And the irony, or not the irony, but the fortunate thing is they have been they've been focusing on this business for many, many years now. And this is an opportunity for them to get into the retail restaurant business in addition to their wedding centers and corporate centers. And yes, you're right, we are going to have dinner at the GEM Center tonight, which they own.
Thanks, Andy. And I think you touched on the hospital investment earlier. So in the interest of leaving some time for questions from the audience, just one more for you, really. We talk about VOF as an access vehicle. We recently saw VinFast list in New York, and I think Vina Gaming's thinking about it. How does that change your outlook and the way you're looking to invest?
Yeah, I think the listing of VinFast is great for Vietnam. Vina Games is great for Vietnam. Vietnam does need a few international brands. And Thailand has 5, 6, 7 great international brands. Vietnam needs to go down that path, and we love to be part of that. So if we, over the next 3, 5, 10 years, can invest in businesses like Vinamilk, Hoa Phat, P&J, and see them go on to the international scene, whether it's a listing in New York. You know, P&J was on the Morgan Stanley screen in the middle of New York, Times Square, a few years back, right? So we're beginning to see some of these businesses go on the international scene. Now, whether it's to access capital, to a listing in NASDAQ or New York, or access the market, both are great. And so by seeing some of these businesses go abroad, we are looking at how easy or how hard it is to raise capital on the international scene. And I've met with a lot of these CEOs and chairmen and boards, and basically what we have is a situation where a lot of investors are coming to Vietnam to access these companies. Let's say today, for example, we have 100 investors come to Vietnam. But now, if P&J or Vina Game would go to New York, they would have access to 1,000 investors or 10,000 investors to access capital. So to me, mathematically, it's significantly easier for them to access capital and maybe even at a lesser cost of capital, right? So the idea here is I like to see more brands go on the international scene, whether to access the international market or to access the capital market. And this is what Vietnam is great for Vietnam, especially if we're going to host the Olympic in 10 years.
Thanks, Andy. Exciting times. Now, enough of the easy questions that you let me ask. It's time for some questions from the audience, if anyone's got any.
Thank you for a very interesting discussion. Just going to your point on lower volatility versus the peer group, how much is that owed to the fact that you can sort of take this private equity approach? And you mentioned briefly downside protections that you do in deals. Is that where that lower volatility stems from, and how much of that is owed to the kind of closed-ended structure that you operate in compared to, say, listed vehicles going into the public markets directly?
So how we measure the standard deviation is the movement of the NAV on, I believe, a weekly or monthly basis over the last 5 years. That's how we measure the standard deviation. And yes, you're right. A good component of that is the fact that we hold on to private equity, which gets revalued every 6 months. That does provide some stability in the portfolio in terms of NAV movement. But the other component, I think is more important, is that the quality of companies that we have on the listed side also demonstrates less volatility than the rest of the market, right? Just as an example, if you look at the standard deviation of the VN index over the same period, it's roughly 26%. And that represents a whole, 700, 800 companies. The companies that we have in the portfolio, I like to think it's a lot more, it's more blue chip and a lot more stable. So a combination of higher quality holding on the listed side as well as private equity holding provides that less volatility in terms of NAV movement.
Thank you.
Another question?
Well, if we've answered all of them, I'll just say thank you very much, Andy and Khanh, for your conversation. For those of you not familiar with listed investment companies, Priyesh has written a two-pager, which is out on the desk with the Vina materials, if you want to, and don't give him too many opportunities to talk about it because he won't get away. But thank you very much indeed.
Thank you.